Okay, all right. So after 3 exciting sharing from industry professionals, I think mine might be more boring. It would be harder to give such a lively coverage of what's really happening. So following the morning and the afternoon earlier exciting discussions, I'm going to take the lead in switching gear to more academic questions. So I will use this opportunity to share a study, an empirical study, trying to understand what's happening, the progress made in big tech or fintech finance. This study is joint work with Lei Liu and Guangli Lu. Okay, I think sort of the question I don't have to motivate anymore, given the short period of time. We know in China, fintech, big tech firm made a lot of progresses using big data, AI in offering financial services, especially Ant Group. As well as New Hope and other firms in the room, so they made a lot of progress in offering these services. So, I mean, these services actually differ quite a bit from early on. We know earlier on, there had been a wave of fintech lending, these P2P lending platforms, right? Which actually created quite a bit of a concern, both among public and the regulators about risk in this area. So we know big data can be very powerful, but yet it's risky, and how risky it is. From finance point of view, right? Especially from a regular point of view, it's about risk, right? How much risk is behind. So far, in academic, we made some progress, but not too much progress in really fully understanding the performance and the business model of big tech lenders. And of course, I think a part of this is due to lack of data. It's very hard to get a lot of data on this. I think in the last few years, when the privacy data protection, and all these regulations put in place actually made this research even harder. So for this project, I'm going to share actually, we lost data sharing access at the moment, so we are really stuck actually. But anyway, so I think Yi actually did a lot of earlier work. Yi was very lucky actually, managed to get it through, right? So I think sort of this is a realistic situation we have to face actually as academic researchers. Yeah, so this project was started a few years ago when we accidentally get to access to a set of loans made by a big tech firm, as well as some loans made by a traditional bank. So which allow us to actually make some comparison, which allow us to understand how much risk is really involved in this lending. So this is basically, I'm going to quickly share what we found. The big tech loans are actually not excessively risky, even though there had been a lot of concern about it. And of course, we also understand that actually many of the borrowers of these loans are actually lack access to traditional bank financing. Despite all of that, actually, there's not a lot of risk. And interestingly, the COVID-19 shock actually falls in the sample period of this study, and even before and after, looking at the change, we find that actually it seems like this big tech lending model was reasonably robust to the COVID shock, which is assuring. And we did some simple look at the sort of how do the big tech lender in our sample make these loans. It seems that its goal is to meet short-term liquidity needs rather than in providing long-term capital investment need. So in that sense, actually, at least in our data, which might be outdated already given how quick this industry moves. At least in this data, it seems that its lending model is still quite a bit different from traditional banks. Okay? The data, due to time, might be very quick. Comes from a bank, a traditional bank called Bank X, right? The name is Wei because of the security reason. And we have a period, loans originated from August 2019 to December 2020. The period is not very long, but the sample actually is pretty large. So the sample covers 10% sample of, oh, by the way, I need to quickly, the background of this is a large commercial bank, but it has a joint syndicated loan program with my bank, which is the main lender of Ant Group, so which is the largest big tech lender in China, as probably also in the world, right? So. So basically, we got from Bank X is 10% random sample of borrowers with business loan from 3 programs of Bank X, including its syndication loan program with my bank. So 10% random sample actually means there are almost 850,000 big tech borrowers from this in the sample. And as well as 35,000 regular loan borrowers of Bank X itself, as well as 113,000 online loan borrowers. The second and third are the regular lending program for Bank X. But the first one is the joint lending, the syndication loan program it had with my bank. So as you can see, sort of this syndication loan program is very large. It covers a lot of borrowers, right? And interestingly, there's also some of these borrowers overlap with each other, so which I will quickly mention later. If you look at the borrower characteristic, it's easy to see that this big tech lending program covers a group of young borrowers which tend to about 10 years younger than regular borrowers of Bank X. And also they are more likely to be from rural area, about actually 1/3 actually were from rural areas. And also these big tech loan borrowers actually tend to lack alternatives. They tend to be the first, take their first loan, especially first business loan from this program. And also, if you look at the sort of the alternative, so other than the loan we observe in the sample, what other credit they have? So the big tech borrowers in our sample tend to have a few other loans, and if they have, the loan balance tend to be much smaller than regular borrowers of Bank X, so substantially lower. If you look at the sort of the characteristic of these loans. So the big tech loan actually tend to, the majority of them, 98% are uncollateralized. But the regular loans of Bank X, they tend to have collateral, okay? And the big tech loan tend to have a higher interest rate, on average 14.6% annualized interest rate, which is about 5 to 6% higher than the regular, either the online loans or the regular loans of Bank X. The maturity, they tend to be roughly the same. Usually it's about 1 year, 6 months or 1 year, that the typical maturity is, right? And the credit limit of big tech loan program is much smaller. So it's actually less than 10%. And the loan size, if you look at the actual loan size, the big tech loan on average is about 8,000 RMB, right? So, but the regular loans of Bank X is about 120,000 RMB, and the online loans are 99,000. So they're substantially larger. So in that sense, sort of these big tech loans tend to be smaller, right? But they have a much higher interest rate. The key issue we are concerned, repayment risk. In our sample, this is a very large sample, over 450,000 loans actually matured in our sample. If you look at the raw number in terms of overdue for over 30 days, big tech loans, it's about 2.6%, which is higher than the other two sets. 1.1% for online loans of Bank X and 1.6% for regular loans of Bank X. But if you look at closely, actually half of the big tech loans in our sample actually are the first loans of these borrowers, right? We know this is a program cover a lot of questionable borrowers, right? And literally taking their first business loans. So if we actually look at the sample, actually separate out these two sets, right? First loans versus actually borrowers who had repaid at least one loan before. So the risk actually differ quite a bit. Those without any loans, first loans actually default rate is 4.2%. But once actually look at the borrowers actually at least paid one loan before, the default rate dropped immediately to 1.2%, which is actually no difference from the regular loans or online loans of Bank X at all, right? So in that sense, sort of, even though the raw number, this big tech loan lending program is slightly riskier, but on the other hand, once you control for obvious, put them sort of with some observables controlled, actually there's virtually no difference. We can do more serious regression analysis, put all the controls in. Of course, you will confirm once you control for obvious, the risk actually across these different programs, even though ex ante you think they would be very different, right? So the difference actually is not there. Our sample actually, despite being short, it covers the period across COVID when the COVID hit in early 2020, right? So across the three programs in our sample, actually, the credit supply is actually very stable for this big tech program, which is the red line here. So the other two programs, because of the Chinese New Year, actually there's a dip, right? So at least, so there's no obvious variation. So the big tech loan lending program was not dramatically changed by this shock. And we can actually even compare before and after. Loans made right before the COVID shock, right after 1 month before and 1 month after. And whether so these loans have any change in their repayment risk. Actually, there's no. So this is very different because a lot of studies look at the sort of this P2P lending platforms, right? So the loans made by those platforms, actually, you see quite a bit of change afterward, right? Risk actually substantially increased. But here in this big tech lending program, there's actually not that much of a change. So in that sense, sort of, this is a lending model at least appear to be quite robust. Okay. One very important feature I want to highlight is actually early repayment. This is one dimension. Actually, big tech loan appear to be quite different from the regular business loans made by Bank X. We know sort of if a borrower takes loan to finance its business expansion, it's unlikely to repay early, right? So most likely they're gonna repay at the end, and also need to take another loan so to repay earlier loan, right? So in this sample, we actually find that the average repayment time of loans in the big tech lending program is 0.46. That means the loans are repaid at the point half time to the maturity, right? So which is actually quite early, substantially earlier than the regular or online loans of Bank X. If you look at actually across different loans, actually 25% of loans are repaid at the time only 4% of the maturity. That means for a 1 year loan, 25% of the loans are actually repaid really just in a week or two, right? So that means actually online borrowers really repay their loans very rapidly, right? So most of the time they just take it for a few weeks and they will repay it, right? So this kind of makes sense because these loans have much higher interest rate, right? So if you don't need, no particular need for it, you want to repay quickly, right? So this also suggests that the use for these loans are very different, right? Clearly, the borrowers are not using the loans for their long-term business expansion, but more likely for working capital or some kind of short-term need, right? So we can do the regression. It's just really confirm that. And actually, as I mentioned earlier, in the sample, we have a small set of big tech borrowers actually also had access to Bank X online or regular loans, which is kind of curious, right? Given that the interest rate on these loans are substantially higher on average, right? So this is the question. So what are they doing with this, right? Despite the high interest rate. So you might say maybe this group of borrowers, given that they have access to regular bank loans, right? Maybe they get a better deal, right? But actually, in our sample, you see there are several thousand of them actually had this overlap access. The interest rate they get are just like average borrowers, 14.5%, which is higher than the interest rate on their regular or online loans from Bank X, which is about 9%. So there's still a big difference. So this makes it quite curious. Then what are they doing with this big tech loan given much higher interest rate, right? So if you look closer into it, of course, they repay very quickly, right? So because they also have the access to alternative and the cheaper credit access, right? They do tend to repay much quickly, right? So then this justifies it, right? They still use it despite the high interest rate because they're going to repay much quickly anyway. So this actually supports another important issue. These big tech loans, because they're fully integrated on the cell phone, right, it's very convenient. The convenience is a key feature here, right? So despite the high interest rate, many of these borrowers are still going to use it anyway because this program is very convenient, right? We did sort of carefully compare overlap the borrowers, this loan versus that. They actually use it even when they literally have free credit lines sitting there from the other regular, cheaper credit source. And when they do this, of course, they tend to be actually, these big tech loans actually, they're more likely to be repaid than the the alternative cheaper credit source, right? Due to the time, I'm not going to go over all of this. So let me quickly mention, if I compare this, right? So there's something about, what's the lending model so far from looking at this sample. I think this sample, how does the big tech lender manage to make these loans without incurring excessive risk, right? Given that this is a pool of borrowers that traditional banks are unwilling to cover, right? So I think a lot of mechanisms already be discussed in the finance literature, right? Information advantage to screen borrowers, monitoring through its ecosystem clearly are there. And the earlier literature already covered. And I think the two additional mechanisms I want to highlight here. One is convenience. That justify why they're willing to, some of the borrowers are willing to use these loans despite their high interest rate and despite they may have alternative, cheaper source of credit, right? I also want to mention, actually, this is perhaps a more curious mechanism, this high interest rate. We know high interest rate in banking literature, right? The classic mechanism by Stiglitz Weiss, right? High interest rate going to be select a riskier borrower, right? So this adverse selection mechanism, right? I think that mechanism is constructed in the environment that people are afraid of defaulting, right? Sorry, they're not afraid of defaulting, right? So when these high risky borrowers are, prepared to default, of course, if you offer them high interest, they still take it because they're not worried about the default cost is not really that high, right? But I think this makes the big tech platform different because defaulting on big tech program for example, in the lender here, in our data set, it's covered in our data set, right? Alipay and the related platform. Defaulting in that platform is very costly to a usual borrower, right? So when defaulting is substantially costly, actually a typical borrower is not prepared to default, right? So in that case, actually, you offer them higher interest rate. You are not necessarily selecting higher risk, right? But rather, actually, you are selecting borrowers who are prepared to pay back early because they just want to use it for liquidity need. So in that sense, actually, in this environment, high interest rate actually might serve a different mechanism, which is the not selecting high risk borrower, but rather selecting a borrower with higher liquidity need. Okay, so let me conclude. So by looking at this data set, we find that actually big tech loans are not necessarily more risky, despite covering a very different set of borrowers, presumably uncertain and risky borrowers. I think sort of the reason for this, of course, the usual mechanisms are there, but I want to highlight sort of convenience as well as this high interest rate actually serving to select borrowers with liquidity need as sort of a more curious new mechanism here. All right.